Thank you for joining and welcome to our webinar, our lunchtime webinar today on cash flow confidence, giving you some insights on the latest options to help your clients. I'm Annie, I'm on the customer success team for Swoop for Advisors, and I'm joined by Tom Hawley, who's the head of advisor funding. So yeah, Tom, can you give us a bit of an update on the current market and what are the common cash flow challenges that you're sort of seeing at the moment?
Yeah, no, thanks, Annie, and yeah, great to see so many join. So my role at Swoop essentially is head of advisor lending. I work with quite a number of our advisor partners to predominantly look at unsecured funding, and when we say unsecured, we mean not tied into any assets or security. So there are a range of kind of products that we can look at. I suppose we'll cover a few today that potentially look outside of maybe your kind of standard business loans or similar. So I suppose the key kind of shift that we've seen over the last 12 to 18 months as we've moved kind of outside of COVID into, I suppose, back to a bit more of a traditional lending market is obviously the pretty significant rise in base rate that we've obviously seen over the last 12 to 18 months. And obviously the knock-on effect of that is that the cost of commercial borrowing has increased. So through COVID, we had some pretty favorable government schemes that were essentially around to see businesses through that kind of very, very volatile period, unprecedented almost in terms of the closing down of the economy. And there were some very favorable repayment terms on that. As we've moved kind of through and back to a much more traditional kind of market, with the rising base rate, there is I suppose a continued shift of expectations in terms of what is actually out there. There is a lot of appetite still to lend. Some lenders have maybe become a little bit more risk averse. So in terms of the amount of funds that were pushed out during COVID, there is a potential shift in terms of essentially how much risk lenders are willing to take on. But there is still appetite out there, although it is more expensive, and it's something that we are always transparent about. So I think it's worth having to think about. Obviously, the cost of commercial borrowing. Maybe we do need to be a little bit more creative with the products that we potentially put in place, and in terms of what that is actually going to look like for clients. I suppose in terms of the common cash flow struggles that we've seen, I mean, there are always kind of the common ones in terms of, especially over the last 12 to 18 months, in terms of increasing costs for businesses. I know we had the energy crisis last year, which we saw a kind of pretty significant increase in inquiries around that. And there are always general seasonality perspectives to businesses as well. So, for example, retail businesses looking to purchase stock heading into the Christmas period as we are now. Potentially those stock purchases maybe needed to be made potentially April, May, June earlier this year. And potentially there was not the cash flow to do so then. And then it's what products that we can put in place to obviously support that. Additionally, tax liabilities are things that we see a lot. Potentially businesses have had to take on expensive debt through COVID, potentially, if there was maybe not some of the cheaper facilities around. So again, cash flow issues can come from a range of kind of sources. And I suppose not even just on a kind of a refinance or type basis, especially when businesses are growing, is something that we see quite a lot. And there's potential funding facilities that we can put in place to support that growth, potentially if they're taking on new contracts, purchasing machinery or potentially hiring staff, etc. So there's a whole host of things out there that we can take a look at.
Amazing. Thanks, Tom. And I guess it's always good to touch on, because we've got so many different solutions. What are you seeing is, I guess, the most common request from our advisors to help their clients with their cash flow concerns?
Yeah. So I mean, the most common that we see is generally going to be the standard business loan, and it's probably the one that most advisors and businesses are aware of course, because it is exactly what you say, that it is a business loan, and that is something that we do have a lot of options for. and there is good appetite out there for lenders to lend up to 5 to 6 years unsecured. We have potentially shorter products that are maybe a little bit more flexible in terms of early repayment. So there's a whole host of options within the business loan kind of space. But there are a lot of other ones which are available. So one potential kind of cash flow solution that we wanted to mention today was around a merchant cash advance, which again is something that is becoming increasingly known about in the market, and is I always think a good alternative to a business loan for some specific for some specific clients. And I suppose the merchant cash advance can be also put in place with any kind of revenue-based facility, where it's essentially leveraging against the revenue in which a business receives, either through a card terminal, potentially an e-commerce platform, and essentially allows you to borrow a proportion of that revenue. So, for example, on a merchant cash advance, let's say we've got we had a business that we put in place a facility for a couple of months ago, who's actually a carpet retailer, and they were struggling with getting some stock in place as they're essentially heading towards a bit of a busy period for them in terms of new contracts and new kind of inquiries coming in. So what this cash advance facility allowed them to do was leverage against the revenue which they're receiving through their card terminal, and allow them essentially to get access to, I think it was around £15,000 from one of our partners. And the main difference between the merchant cash advance against the standard business loan is that there is essentially the kind of difference in repayment. So how that merchant cash advance is actually repaid is through a percentage of the revenue in which the business receives. So rather than you having a fixed monthly or weekly repayment, which business loans will have, you pay back as a percentage of that revenue. So in terms of the cash flow cycles of these businesses, so predominantly retail and hospitality are the main ones that we see for this cash advance because of the use of card terminals. What we do see is that when you are having a great period, obviously your repayments will go in line with that. Or let's say maybe you're having a little bit of a down month, your repayments will obviously come down with what that revenue is seen as. So again, gives them a little bit more flexibility if they do go through some difficult times, especially for businesses who are impacted by seasonality and differences in terms of kind of business cycles and demand, that repayments aren't fixed and therefore don't have such of a chunky impact on cash flow. So again, it is one of our most kind of put in place products, and one that again is going to be reliant on businesses that either take through card terminals or e-commerce platforms, but I think gives a really good alternative to the standard business loan in terms of the flexibility side.
Amazing. And I guess in terms of spotting opportunities for advisors on here today, just thinking, if you've got clients that are taking payments via card terminals, and they could be eligible for the merchant cash advance, if they're looking to refinance debt, or have got new contracts on the horizon, definitely worth pointing out that you and the sort of other funding managers, you look at everything holistically. So there's no sort of one solution fits all. You look at the business and ensure that you've got the best solution for them as well.
Yeah, definitely. And I suppose it's the advantage of Swoop as essentially a marketplace for these different products is that when we do get an inquiry, and it may be the case of the business, I want to borrow 50,000 over 12 months to support my cash flow, for example. And I think the different options that we have, there may be something that's more suitable. We may talk them through this cash advance product. It works well for them in terms of their business cycles, and it may be something that's more suitable. So again, in terms of the accountants looking for opportunities, just any conversation is open-ended for us. We're always happy to have that chat, even if it's not one for us right now. It may be something that we can look to stay in touch with 3, 6, 9, 12 months and beyond, and still look to support the client.
Amazing. And I'd say something that I'm seeing a lot of at the moment in conversations that I'm having is talk around tax funding. And I think this is something that's sometimes got quite negative connotations, but actually we're seeing a lot of positives that can be taken from tax funding and how it can be used for business growth. So it'd be amazing to sort of just talk through that if you can, Tom.
Yeah, no, definitely. And I think tax funding is becoming an increasingly discussed product. And I think, yeah, there's becoming a lot more kind of demand. We're actually starting to get a few of our advisor partners and businesses come to us looking for tax funding, whereas a lot of times we talk about it, maybe it's the first time that an accountant or a business has actually heard of this. So I suppose at the crux of it, a tax funding product or facility is essentially a business loan that is used to specifically fund that liability. So the main ones that we see generally are going to be funding VAT, corporation tax, or potentially a director's self-assessment tax bill. And what this essentially does is allow the business to spread the cost of that liability over a period of time. So, for example, if we're looking at a VAT loan where a business has a quarterly VAT liability, which they're having to obviously pay to HMRC, in an ideal world, a business will keep a separate business account, put all the funds that they have for their VAT, and it goes into there. In reality, things can get in the way, and it's completely understandable because, like I say, we've had such significant shifts in the market the last 12, 24 months. I mean, even if we go back to 2020 with COVID, things have been difficult for businesses. So in some situations, we find that businesses aren't able to do so. And it may be a little bit daunting every quarter that got tax, got our VAT bill coming up potentially today for some businesses on the 7th of the month. And I think having access to, and what essentially this product does is allow them to spread the liability over a period of time. So, for example, the VAT loan specifically is a 3-month loan facility, which essentially just positions that quarterly liability into 3 monthly repayments. So what we have found is that in terms of a cash flow position, where obviously that quarterly payment which they need to make to HMRC can have a pretty chunky hit on their cash flow, especially if maybe they've not managed to keep the funds back for it, or there's potential other kind of projects, costs going on which come into the business which either haven't been foreseen or maybe are to be expected, but in terms of the potential growth. So I think firstly from a cash flow, it really smooths out, rather than there being the chunky kind of quarterly liability, it smooths it out into those 3 monthly repayments. And I suppose not just from a cash flow perspective. So one client that we've worked with previously actually utilised this facility to firstly obviously smooth out their cash flow, but allow them to take on a couple of additional members of staff, which was really important for them. They were struggling with recruitment fees, which I speak a lot about. Recruitment within the accountancy sector, which speaks to a lot of our advisors about at the moment. They managed to get 2 great candidates. They wanted to hire them both, but they didn't potentially have the cash flow to do so. So what they were able to do was utilise this VAT facility, spread their next 2 quarters over to HMRC, just while those 2 members of staff got onboarded, started to turn over their own clients and started to see a return on their salary. So I suppose a key thing here is that these facilities aren't just used, let's say if they're in last chance saloon type, I can't afford to pay this debt. It can be used as a tool for growth rather than like you say, just a kind of last chance. One thing I did want to mention as well, just in regards to the tax funding side, was we are seeing, and the feedback that we are seeing from businesses is that HMRC are maybe being less lenient with time to pays.
Yeah.
And this can be a cost-effective solution against surcharges which potentially businesses can incur. So like I say, go on, Tony.
I was going to say, and with regards to sort of credit checks and credit scores, does that have an effect on that, Tom?
Yeah, so I suppose any kind of application for funding is going to essentially incur a credit check against the business. I suppose it's key to think around these VAT loans and tax funding in general as close to a business loan application. So we would want to see good business credit, essentially. Adverse credit can of course impact applications. I suppose it's again, likened to a standard business loan. So again, if the businesses maybe have significant HMRC liabilities that are outstanding, it may be difficult for a lender to put something in place. Similarly, if there was missed payments on current facilities and so on. So again, it isn't going to be one that's eligible for that everyone is eligible for. Sorry, but again, is something that we can almost broach in terms of a first conversation with a business and an advisor to give a kind of transparent outlook on what's going to be out there and what's going to be possible.
Amazing. And what about businesses that sort of don't need help paying their VAT, but are waiting on, I think at the moment, what can feel like a really long time for their refunds?
Yeah, so I mean, again, tax funding can work in both ways. We obviously, businesses every quarter may have HMRC owe them some money. So one product that we can take a look at through our partners is look at essentially advancing against VAT payments that are due to them. We have one partner who can turn around facilities under 100k in 60 minutes. So I think utilising Swoop's tech along with their tech to get kind of quick decisions to businesses and allow them to utilise those funds at the road. Similarly for R&D advances as well. So R&D is something that we're seeing a lot of at the moment, and businesses utilising that tax scheme, and what we can take a look at is advancing those funds rather than a potential kind of wait time, especially with the new regulations, in terms of those funds actually businesses receiving those funds and making use of them. So it can work in both ways, Anna. You're absolutely right.
Brilliant, amazing. And I guess in regards to like spotting opportunities, it would be looking at any clients that are struggling to pay HMRC, again looking to improve their cash flow, or looking to grow as well, but don't have the means to do it. There are these sort of options to get that cash back into their business. It'd be great to sort of talk through other products that are more flexible, and sort of business loans or merchant cash advances, but it can still give a business sort of breathing room, and keep their cash in their business.
Yeah, definitely. And I suppose there are facilities out there that are a little bit more flexible than, like you say, your kind of structured business loans, which is essentially keep it X amount of funds over 3 to 5 years, whatever it may be. So one that we did have access to that was around probably kind of pre-COVID and was quite heavily utilised in the market was a revolving credit facility, which is closer to an overdraft, or as we term it. A lot of those facilities have actually come out of the market, I suppose a knock-on effect of the base rate increase and it actually being viable for lenders. But one new product, which is, I suppose, does retain kind of the flexibility that funders do have, but it's maybe a little bit more kind of structured in terms of how businesses utilize their funds, is actually something called supplier finance. I suppose close to trade finance, but more kind of focused on payments within the UK. I suppose they can still make payments abroad, but I suppose a supplier finance product per se is a facility that gives businesses access to a credit limit, which they can then utilize to spread payments to their suppliers. So I always think good to use a case study. So, for example, I had a business that I was working with a few months ago who work in the food manufacturing sector. Their growth was absolutely massive through some kind of large retail contracts that they've won. And what they needed to do was really accelerate that growth by increasing their production, essentially. And what they needed to do was improve their efficiencies, buy a couple of new machines, and also increase the kind of stock that they had of what they were inputting. And so we got them a 200k supplier finance product, which allowed them to pay, essentially get everything they needed to really accelerate that growth, but also spread the payments to their suppliers over 3, 6, 9 or 12 months, completely dependent on how they wanted to structure it. And what that did was firstly allow them to obviously pay them on time, where potentially suppliers were unable to provide credit. It allowed them to meet the increasing demand, and then obviously the revenue has massively exploded since then. Because it's a revolving facility, they will only pay interest on the invoices or the supplier payments in which they want to utilize or spread over a term. So anything within that limit, and obviously as you make payments back, you essentially get that facility limit again. So again, it's a likened to a revolving facility, which gives them the opportunity to continue to make those payments to suppliers. Again, it is a little bit restrictive over a pure kind of revolving credit facility, so you can't use it on, let's say, your payroll, but anything external is something that can be utilised, and again, retains that flexibility over and above maybe a kind of business loan or cash advance facility.
Amazing. Thank you. Thanks, Tom. Thanks for running through all of that. I know it's sort of quite hard to keep to time when there's so much, but I think we're doing well. And I should have actually welcomed everyone to ask questions at any point. There is a Q&A box just at the bottom. I think we've got a couple in there. So let's have a look and run through these. So we've got, is there funding available to help retail companies over the festive period? I think we've sort of touched on that with the merchant cash advances. And if you've got specific clients, do reach out to us and we can set up a chat with Tom. Another question we've got.
I suppose just on that one, Annie, I suppose again, the funding for retail business, again, the MCAs are one that we see a lot because again, retail companies, a lot of B2C work, they'll potentially take a lot of card payments. But again, what we'll always do is take a holistic view of things, because it may be the case of that, well, actually, they just need a little bit of breathing room, would essentially spread in their next VAT liability over 3 months, give them a little bit of additional cash flow to then go and make those stock purchases, or so there's loads. Again, we'll take a review across the whole market in terms of the different things that we can look at for that one.
Amazing, thanks. And question that's just come in: how quickly can retailers benefit from the merchant cash advance facility? Thanks, Tony.
So Tony, in terms of how quick, and I assume you mean in terms of how quick a facility can be put in place, the answer is very quickly. We have lenders who could turn around, I'd probably say within 24 hours of them receiving the application. Very dependent on, I suppose, how kind of not necessarily easy the application process is, but if it's quite clear in terms of us having the information available to us, so your bank statement, your last set of accounts, and your director details. Once we submit that to the lender, if it's if the business maybe has good credit and there's not any questions from underwriting, you'll generally get a decision within 24 hours. I suppose the next key bit there is potentially which terminal provider they use, because some facilities will, essentially it may take up to kind of a week for them to get to get the funds actually deposited, or it may take up to kind of 2 to 3 days. So again, really on a case by case basis. But what I would say is that we can move as fast as you guys, and I suppose working with advisors, getting access to that information quickly allows us to really speed up that process with lenders. I'd say anywhere from kind of 2 to 3 days to a week.
Brilliant, thank you. We've got another one here, which is: will directors be expected to give personal guarantees to sit behind a facility?
Yes. So again, it's a conversation that we will always broach with the initial conversation with the business or directors, with business or advisors, depending on kind of how we're working with them. And the answer is, in terms of where the market currently is positioned, is that the majority of facilities are going to request a guarantee from the directors to sit behind that loan. So always key to understand kind of what this actually means for the directors, because completely understand that there may be apprehension around giving that guarantee. And all this is essentially is an agreement that sits behind the loan facility, which essentially gives the lender a little bit more comfortability that there is essentially buy-in from the director. There are no charges against personal assets. So it's not like there's, potentially there's going to be a kind of a legal charge against the director's property. But it's just purely there to say, if the business is unable to repay that debt, that that the director potentially could become liable. All the lenders that we do work with will try and find another solution before getting to that point. And we do also work with a PG insurance partner, which we can essentially put an insurance policy against that guarantee. So again, something that we'll always be transparent with, because what we'll never want to do is have surprises, maybe potentially when offers come in for our clients. And again, especially for a sensitive subject such as that.
Yeah, amazing. Thank you. And I think there's just one more, which is, how would you approach a business with adverse credit?
So again, it's adverse credit is again something that is, I wouldn't say prevalent in the market, but is something that we need to deal with, because we understand that events may happen within a business that can impact them adversely. There may be things that are out of their control which have happened. And I suppose how we always deal with that is to try and be completely as transparent as possible. If we're looking in terms of, if we use a potential business loan as an example, there's always going to be lenders which are going to be more averse to risk than those who are able, or their policy allows them to take on more risk. And I suppose that's where we see the difference in interest rate. So if, let's say, a business does have some potential adverse credit on the personal side, or there is, there may be some other issues with the business, potentially they missed a couple of payments, we'll always be transparent with lenders on that, because the more open and honest we are with them, the more favorably we can see that there's, the kind of knock-on effect of that, and there's potentially no skeletons in the closet. So what we will always say, if we know exactly what we're dealing with, for example, if there's a CCJ or there's potentially a default in there, what we'll always do and just be transparent about the pricing that we're probably going to see. Because if there is adverse, it's likely going to be a higher rate than other facilities where maybe there's squeaky clean credit and so on. So again, one that we deal with regularly.
Fantastic. And I think that's it. So thank you so much, everyone, for joining. What we'll do is send an email out tomorrow with this recording so that you've got that. Do feel free to share that with your teams. If anyone's got any questions, then please reach out to myself or Tom. It's Annie@swoopfunding.com or Tom@swoopfunding.com. We'd be very happy to answer your questions. Thank you very much. Goodbye.
Thanks, guys. Bye-bye.